Okay, here we're going to look at adjusting entries. And adjusting entries are based on the accrual accounting matching principle, where we allocate our income and our expenditures to the period in which they actually occurred and for their correct amounts. Now, the actual cash may have been received or paid at a different time than the expense or revenue recognized, but nonetheless, we still have to allocate our revenue and expenses for when they actually occurred. Now, adjusting entries require both a balance sheet and an income statement account when they're made. Adjusting entries are classified into 4 different types. For our liabilities on the balance sheet, we'd have our unearned revenue and our accounts payable. For our assets on the balance sheet, we'd have our accounts receivable and our inventory or prepaid expenses. Now, our unearned revenue, that would be recognized as a revenue here on the income statement, and our accounts payable would be recognized as an expense here on the income statement. And then our accounts receivable would be a revenue on the income statement, and our inventory or prepaid expenses would be an expense here on the income statement. Now, adjusting entries have to affect both a balance sheet account and an income statement account. So what I'll go through here is a brief explanation of each one of these adjusting entries, and then we'll go through an example and show how to actually make an adjusting entry. Okay, here we'll look at adjusting entries for revenues. For our unearned revenue, this is where we received cash payment in advance of doing any work or providing something to our customer. So at that time, we'd credit or increase our unearned revenue, and then we'd debit or increase our cash for the amount of the cash payment that we received. Now, that would not be the adjusting entry. But when we earn this revenue, we'd debit or decrease our unearned revenue, and then we'd credit or increase our revenue account here on the income statement. Now, that would be our adjusting entry to allocate that revenue. Now, for our accounts receivable, this is where we earn something in advance of any cash payment that we received. So at the time that we earn this in advance, we debit our accounts receivable, and then we'd credit or increase our revenue account here on the income statement. Now, that would be our adjusting entry here to allocate this revenue. Now, at the time that we receive cash payments for any on our accounts receivable here, we credit or reduce our accounts receivable, and then we debit or increase our cash account for the amount of that payment. Now, that would not be the adjusting entry. All right, our adjusting entries for expenses. First would be our accounts payable. This is where we incurred an expense or we purchased something on credit prior to making payments. So at the time of that incurring that expense, we'd credit or increase our accounts payable, and then we'd debit or we'd increase our expense on the income statement. Now, that would be an adjusting entry here to allocate our expense. So when we make payments on this accounts payable, we debit or reduce our accounts payable, and then we'd credit and reduce our cash for that amount of that payment. Now, that would not be an adjusting entry. Now, for our inventory and our prepaid expenses, that's where we pay for something in advance of actually using it. So at the time that we make this purchase or pay for this inventory in advance, we debit or increase our inventory or our prepaid expense account, and then we'd credit or reduce our cash for the amount of that purchase. Now, that would not be an adjusting entry. Now, when we actually use this inventory or prepaid expense, we'd credit or reduce our inventory account here, and then we'd debit or increase our expense here on the income statement. Now, that would be an adjusting entry here to allocate our expense. Now, you noted here that our adjusting entries affected both a balance sheet account and an income statement account. I'm going to be going through a few examples here for adjusting entries. And by definition, when we're looking at our account, our preliminary balance in that account, that's based on our accounting records for the period that do not include the proper allocation of revenue or expense. Now, our correct balance, that's where we went through our accounting records and we determined what the correct allocation should be for either that revenue or expense. Okay, let's look at how we'd apply these adjusting entries. And the first thing we do is set up T accounts for our revenue and expense accounts here on the balance sheet and also on our income statement. So let's look at the example here of our accounts receivable here on our balance sheet. So the first thing you have to determine is what the ending balance should be in the account, and that would be our correct balance. So, and then the second thing you have to do is determine what adjustments you have to make. So to determine this adjustment here, we take our preliminary balance. In this case, it was $50,000 here on our debit to accounts receivable, and our correct balance should have been $54,000. So we know that we have to make an adjusting entry here by increasing our accounts receivable by $4,000. So the $4,000 plus the $50,000, that would the preliminary balance would be equal to $54,000, or our correct balance. Now when we made this adjustment here to our accounts receivable, we also have to have the same adjustment here on our income statement, and that would be to our revenue account. So our debit to accounts receivable here of $4,000, we'd have to credit or increase our revenue for $4,000. So if we had a preliminary balance here of $150,000 in our revenue account, and you add to it this increase here of $4,000 adjusting entry, we would have $154,000 in our revenue account. So to make these adjustment entries, you have to make the adjustment here on your balance sheet to whatever revenue or expense account that it represented, and then the same adjustment have to be made here on your income statement to the appropriate revenue or expense account. Okay, let's look at an adjusting entry to our accounts payable. Our correct balance at the end of the period should be $12,000. Preliminary balance was $15,000. So we have to make an adjusting entry, and that would be to reduce our accounts payable here by $3,000. So the $15,000 credit less the $3,000 debit here in accounts payable equals our correct balance here of $12,000. So when we made this adjusting entry here on our balance sheet to our accounts payable for $3,000, the debit amount here, we have to have the same adjusting entry here on our income statement. So in this case, we'd credit or reduce our expenses by $3,000. The credit here of $3,000 balances here with the debit of $3,000 here in our accounts payable. So our new balance here in our expense account would be, say, the beginning balance here or preliminary balance was $60,000 less the $3,000 here reduction in our expenses. The new balance here would be $57,000. So we've made this adjusting entry here on our balance sheet to accounts payable. We decreased it by $3,000 or debited it for $3,000. Well, we had to have a balancing adjusting entry here on our income statement, and that would have been to credit or reduce our expenses for $3,000. Okay, let's look at an adjustment to inventory. For the year we charged off $10,000 worth of inventory, so we credit or reduce our inventory for $10,000, and then we debit or increase our expenses for that amount. And then we did an end of the year count for our inventory, and we determined that we actually had $500 worth more inventory than what we originally estimated. So we'd debit or increase our inventory for $500, and then we'd credit or reduce our expenses for $500. So we reduced our expense here from $10,000 less the $500 here credit, and then our total expense here would have been $9,500 for the inventory. And then we also adjusted our inventory account here by increased it for $500. So in both cases, we made an adjusting entries here to our inventory account, and the adjusting entry here in our asset or inventory balances with any adjusting entries here in our expense and net income. All right, to summarize on how we calculated our adjusting entry, the first thing we had to do is to determine what the correct balance should be at the end of the period or the end of the year for our account. Then we looked at the preliminary balance that was in the account, and then what the difference here would have been our adjusting entry, the difference between the preliminary balance and the correct balance. And then any adjusting entries here we made on the balance sheet had to be balanced with a revenue and expense account here on the income statement.